Does overvaluation of homes make home ownership a risky move right here in San Diego? That's what we're going to break down. A recent article from the Union Tribune, dive into what overvaluation is, jump into a few experts and break down half said yes, half said no, and I'll give you my 2 cents and my insight onto all their points to give you a little bit behind the scenes what's happening right here in the San Diego real estate market. As always, if you guys are ever thinking about making the move, buying or selling, I'm Chris Erickson, and we have a real estate crew right here in San Diego. All of our contact info is right below. Feel free to reach out, call, text, email, whatever is easiest for you. We got your back when making the move here in San Diego. So the national home prices have risen nearly 50% since the end of 2019. Overvaluation is a predictor of stagnant, even negative real returns in the coming years. And a few financial models from the Federal Reserve and John Burns Research have homes overvalued from 25 to nearly 40%. Now, I wasn't able to find these exact reports, but I have another data point we'll jump into to see if the San Diego housing market is overvalued. On this map, we have highlighted the overvalued percent of different housing markets right here in the US. As we zoom into San Diego, you see the blue ones are potentially undervalued. The more red it is, the potentially overvalued they are. As we zoom into San Diego, you're going to see it pop up right about here, saying that San Diego homes are overvalued by 22.1%. Now, how are they coming up with this overvalued percentage? An estimate of how over or undervalued current home values in the area are relative to the fundamentals dictated by local median incomes. The overvaluation percent is calculated by comparing the area's current value/income ratio to long-term average. So note that this is not a projection of how much home prices will increase or decline, but merely an estimate of over or undervaluation compared to incomes at a given point in time. So right here, they're charting it at this year, 2024, June 2024, 22.1% overvalued. Last year, it was 13.4%. At the height and the peak of the market frenziness, it was 26.6% overvalued. You can see it started to jump up since June of 2020. So our homes right here in San Diego overvalued. If you're thinking about from like 2019, think of like a $900,000 house in Carlsbad, what that house is looking like now. You can see there's been a big run up, and that really comes down to supply and demand, how many buyers were out there. Also, the cost of capital was super low, so people were able to leverage their money a lot more when interest rates were 3, 4, 5%. But in order to make up some sort of delta, and let's say prices do come down that amount, you're gonna have to see something that happened like 2007, 2008, a big supply of homes coming on the market. That's what caused a big crash back then. We don't necessarily see that now, and we'll get into that in a few of these points. But not only has the number of homes been relatively low over these past few years, the number of homes for sale, the number of sellers out there. This article also states that there was only 1,255 new single-family homes built in 2023 here in San Diego. If you're watching the news and seeing things about real estate crashes and stuff like that, sometimes they're talking about commercial crashes. That's part of the real estate market as well. But also areas where they're seeing big inventory growth, Florida's, Texas's, Idaho's, that kind of stuff. That's a lot of the areas where they do have a ton of new construction. So they have a ton of new homes coming on the market, a ton of new supply with the lessening amount of buyers out there. Here in San Diego, it's a little bit different story. Now, the question is, does overvaluation of homes make home ownership a risky move? James Hamilton says yes. House prices have gone up faster than inflation over the past 5 years, and interest rates are much higher, which is definitely true. Back in 2021, 2022, they were sub 5%. Now we've been sitting close to that 7% range for quite a while. Both factors mean substantially bigger monthly mortgage payments, which is true. It's gone up quite a bit. That comes down to that purchasing power. Many people are assuming that housing prices will continue to go up and mortgage rates will come down, allowing them to refinance with capital gain. But either of those assumptions could prove wrong. And he makes a really good point here. You shouldn't take on monthly payments that you can't sustain. And that's what we always preach to clients. You have to be super comfortable with your monthly payment because that's what you're going to be paying for potentially the next 30 years. Don't bank on interest rates falling. Like, go into it with the mindset of, I want to be comfortable now. Don't bank on the fact of something out of your control that might happen or might not happen. Now, hopping into what Bob said, he also says, yes, there is more risk now than a few years ago when prices were valued more modestly and interest rates were low. Obviously, you're getting the home at a lower price and interest rates were at a lower price. Both of those together means that your monthly payments were going to be less. The mortgage amount that you're going to have to take out is potentially less. The down payment could potentially be less. So it was just less risk, less money out there. But I do not see prices dropping much, even in a recession. Underwriting has become more professional and loans more conservative. So back in 2007, 2008, a lot of the loans, a lot of the people who got in trouble were assuming that they could basically get into an adjustable rate mortgage. And when those rates did adjust, they got in at a super low rate. The rates did adjust in 1, 2, 3 years, whatever it was. Their payments went up excessively. And at that point, they could no longer afford the house. The percentage of people right now in adjustable rate mortgages is much lower than it was then. Further, there remains a supply shortage. So prices have a low risk of steep declines, but the reward of solid value increases is modest in the short term, which is sort of true right now, as over the past few years, the rate of increase right here in home prices in San Diego was on this kind of trajectory. Now we're seeing it flatten out a little bit, but we haven't seen those drops. In two ways that you would have a drop is if there was very limited buyer demand and more supply, more homes coming on the market. Now, right now, we are seeing more homes come on the market compared to last year, and buyer demand is down a little bit. But the amount of homes compared to last year, we're coming off like super low lows, where in a normal year like 2019, we're still nowhere near where those levels were as far as the number of homes on the market. So there's still a big gap in our current supply compared to a supply like in a normalized year. Kelly Cunningham says yes as well. Buying homes always has risk, especially considering the amount paid and when purchased. Higher prices make riskier prospects. Higher mortgage rates, including down payment, closing costs, and moving expenses, compound risks. Real estate is also an illiquid asset, requiring some time to sell if needing capital. And that's one thing to also incorporate into your home buying purchase is obviously, rates, obviously the purchase price of the home. But one thing that people don't take into account is closing costs, which is an extra expense. It could be lender's fees. It could potentially be agent fees. It could be escrow, title. There's other things within the transaction that need to be accounted for beyond just the down payment. Coastal California retains high value because of the desirable location, but market fluctuations can get out of reasonable proportion. Volatile relationships between supply and demand always remain economic considerations. So back to if we do see a bunch of supply and a lot less demand. Now, demand, like I said, has been going down a little bit, partially because prices have gone up significantly over these past few years. So there's less buyers out there, but also the mortgage rates, there's a lot of marginal buyers who are sitting on the sidelines waiting for rates to drop. So at what point do those buyers come back into the market? There's no real saying, but obviously the lower the interest rates go, you would assume the more buyers would potentially come back to the market. And on the supply side, yes, a lot of people, anybody who's bought over these past few years is likely going to have a decent amount of equity. They're going to have lower interest rates, which is kind of holding back supply a little bit. They would rather stay comfortable in what their payment is right now. They have a 30-year fixed rate at 3.5% or whatever it might be. So their mortgage is super low and they bought their house 5-10 years ago. So right now, a lot of people out there who are selling their home, it's kind of life events things. You know, they're moving out, they're changing jobs, they are upsizing, they got some kids, downsizing, whatever the case might be. But the whole supply side of this equation has been drastically low over the past few years. Now, jumping into a few of the no's. Austin says no. Primary home ownership has proven to be a stable, long-term investment. Prices could be relatively high today, but if you hold for more than 10 years, you are likely to profit from a sale, meanwhile reaping annual tax benefits. So something when you do own your home, there's a specific, talk to your tax person, but there are tax benefits involved if you do have a mortgage and that kind of stuff. So talk to your tax professional and see what those could be for your situation. Even when the market crashed, if you had purchased near 2007, prices returned by 2016. So speculative investments over shorter periods have less reliability, which is something as we are consulting with clients, as we are trying to provide as much value as we can as real estate agents, they're asking, is now a good time? Is now, it's always like, well, what's your situation? What's your goals? Are you going to just be there for 2 years? Are you potentially going to be there 5 to 10 years? The risk on a longer term horizon is a lot less. Also remember that maintaining property can be expensive and ties up capital that cannot be invested elsewhere, which is another good point. If you own your home, you're going to have costs. You're going to have upkeep. You're going to have maintenance. Do you have a yard or do you have a pool? Just even stuff. Is your water heater potentially going to go out? Maybe new roof. Now, if you live in a condo, some of those things are taken care of through the HOA. Like if you live in a condo complex, sometimes the roofs are taken care of, the fences, the outdoor painting, the landscaping, all that kind of stuff. But for single family homes, most of that is going to be your responsibility. Now, even condos, you're likely responsible for any of the interior stuff. So water heaters, furnaces, ACs, all that kind of stuff. But there are some things that are likely included in your monthly dues. Jamie also says no. If you have a strong financial picture and can purchase a home now, regardless of interest rates or cost, then this provides an opportunity to buy or invest when demand is suppressed. And I'll give a shout out to another YouTuber that I watch. His name's Michael Zuber, One Rental at a Time. Great videos, great information. He's got a ton of experience in investing, all that kind of stuff through real estate. So go check him out. But as you get less buyers out there, especially going into the latter part of the year, there will be opportunities. Now, he's talking on the investment front mostly, but even for home buyers, just typical home buyers out there, usually in general, as you go towards the end of the year, anyways, not even in this current cycle right now, as you go through the end of the year, the number of buyers in the market kind of subsides a little bit as you go back. Kids are back in school, going towards the holidays. Some buyers can't play in this market right now due to their finances or high interest rates. So they're sitting on the sidelines waiting for that situation to improve, which, as I mentioned earlier, at what point, at what interest rate do those buyers that are sitting on the sideline jump back in? At that point, there's going to be more buyers in the market, which means more competition for buyers out there. Now, at that time, are we going to have more sellers? Have we built up enough inventory to take on the amount of buyers that we do have out there? That is what we'll keep an eye on over these next few months. For those who can play today, homeownership can continue to build wealth and be an asset. Now, hopping into Lynn's take on it, she says no as well. There are three classes of home buyers: short-term home flippers, investors looking to convert housing into rental properties, and home buyers looking for places to live themselves. Various metrics of prices versus rents suggest that the first two investor classes may be disappointed by subpar returns. Now, one thing about the short-term home flippers, we have seen a rise of that over these past few years. And even right now, in an elevated interest rate environment and a slowing demand from buyers out there, still seeing a lot of homes being flipped out there. There's still opportunities where these home flippers are coming in, getting the home at a decent value, fixing it up. They have their systems, they have their processes, and still selling it for a profit on the end. However, the core group of buyers will not see home values fall below the cost of their mortgages as in the last lending crisis in 2007 to 2009, which right here in San Diego, a lot of homeowners have bought the home here over the past few years. They built up equity, plus another piece of the puzzle, depending on what you put down, that's also equity in your home. So you already have that in there. If home values go up, you have increases on top of that. Plus, every month you're paying off a portion, even though in the beginning, if you do have a mortgage, a lot of that initial mortgage is going to interest, but you are still paying off a portion of your principal every single month. So back to the beginning, does overvaluation make home buying risky? It really depends on all those factors we just went through: your time horizon, what are your goals, how much you putting down, what areas you looking at, what is your job situation looking like. There is a lot of things to think about as you are going through the home buying process. So if you want to start that conversation and figure out if now is the time for you, even if you're selling right now, if you want to start that conversation, that's what we do right here in San Diego. We help home buyers and home sellers. I'm Chris Erickson. We got a real estate crew here. And whenever the time is right down below, first link in the description. Feel free to reach out whenever you're ready because we got your back when making the move here in San Diego.